I'm Andrew Murphy, Co-Chief Investment Officer at Winthrop Wealth, and welcome to our third quarter 2021 market review and outlook. Today I'll recap some of the major developments in financial markets in the third quarter and provide context for our outlook and portfolio positioning going forward. From everyone here at Winthrop Wealth, we hope that you had a great summer and are now enjoying the fall season. Of course, please contact us if you have any questions, and we look forward to speaking with you soon.
Today we'll provide an update on the Fed's latest policies, look at the most recent inflation readings, check in on interest rates in the bond market, and then we'll recap what happened in the equity market before moving on to our outlook and portfolio positioning. Let's start with the Fed, because as we wrote about in our client question piece, the Fed has a major impact on interest rates, inflation, the economy, and stock prices. The Fed's response to the global pandemic, lowering interest rates to zero, restarting their quantitative easing program, which increased their balance sheet to nearly $8.5 trillion, helped save the economy from a major recession. But now as the economy is on the path to recovery and inflation pressures are rising, the Fed is starting to gradually move away from their ultra-accommodative monetary policy. The Fed's first move will be tapering their quantitative easing program. They are currently purchasing at least $80 billion in treasuries and $40 billion in agency mortgage-backed securities per month, in part to help keep long-term interest rates low. But the Fed has signaled that the taper, or just purchasing less bonds each month, will likely start in November and conclude around the middle of 2022. The Fed is still in no hurry to raise interest rates, but about half of the FOMC members forecast one rate hike by the end of next year. So overall, monetary policy will still be considered accommodative for at least the next year or two, but that level of support is decreasing. Now let's take a look at the latest inflation data. The most recent core PCE inflation readings for June, July, and August all came in at 3.6% year over year, which is far above the Fed's target of about 2%. Well, Fed Chair Powell admitted that it is frustrating to see bottlenecks and supply chain problems not getting better and holding longer than we thought, he still believes the recent increase in inflation will be transitory. The latest FOMC projections show inflation ending the year at 3.7% before falling to 2.3% in 2022 and 2.2% in 2023. We also believe that inflation is likely to decelerate back towards 2% next year due to the Fed's influence and the deflationary forces of technological innovation, aging demographics, and globalization. And as a reminder, we are still trying to combat the current rise in inflation by holding little cash in portfolios, avoiding long-term bonds, and overweighting equities of companies that are able to grow their cash flows, earnings, and dividends. Please see our client question on inflation that details how the data is calculated, why the Fed targets inflation, and the impact it has on various asset classes. Let's do a quick check on interest rates in the bond market. This chart shows the Bloomberg Barclays U.S. Aggregate Bond Index, which is a proxy for the investment-grade bond market, in blue, and the 10-year yield in gray. 10-year Treasury yield increased by about 2 basis points in the quarter to end at 1.49%. Yields were pretty much range-bound throughout the quarter before increasing by 20 basis points in the last 6 trading days of September. Interest rates move inversely to bond prices, and the small move higher in rates didn't have much of an impact on returns as the Ag Index increased by 0.1% in Q3. Now for the equity market. The S&P 500 posted a small gain of 0.6% in the third quarter, bringing the 2021 total to 15.9%. The market reached a new all-time high on September 2nd when the S&P closed at 4537. However, volatility increased from there as the market declined by about 5% through the end of September. And that ended the S&P 500 streak of over 200 trading days without a 5% pullback, which was one of the 10 longest stretches since 1929. We will continue to point out that volatility is a common occurrence in the stock market, and we do cover that topic in our latest client question titled, "How often does the stock market decline?" Last, let's move to our outlook. After declining by nearly 34% during the pandemic sell-off last year, The S&P 500 is up by over 97% from the low, with very little volatility along the way. As we mentioned in the past, the market rally was driven by 5 pillars: the vaccine rollout, fiscal stimulus, accommodative monetary policy, strong economic growth, and strong corporate earnings growth. Going forward, while the pillars remain strong, markets will begin to transition as we have now reached peak growth rates. For fiscal policy, even if Congress passes the full infrastructure and budget reconciliation bill, the level of fiscal stimulus will be less than the $5 trillion plus that was passed since the start of the pandemic. Monetary policy will become less accommodative as the Fed has signaled their desire to start tapering the quantitative easing program. And the economy is performing well, but GDP will likely decelerate from about 6% in 2021 to 4% in 2022. S&P 500 earnings are expected to slow from over 40% this year to about 10% next year. So while the absolute levels will remain high in 2022, the growth rates are decelerating as we move further away from the pandemic. We'll also point out several market risks, including higher interest rates and inflation, the possibility the Fed may tighten earlier than expected, the upcoming debt ceiling deadline, instability in China, and the potential for higher taxes. While we're pleasantly surprised at the stock market performance over the last 18 months, we know that stocks do not move in a straight line forever, and more volatility is inevitable. We prepared by shifting portfolios more defensively and continuing to take profits as the market moved higher. Just because we are anticipating volatility doesn't mean that we are predicting a market crash. We are simply expecting the investment environment to get tougher as both volatility and market returns revert toward historical averages. On the equity side, we remain tilted toward high-quality U.S. stocks. On the fixed income side, we continue to focus on achieving balanced stability in income while accounting for short-term cash needs. As always, we will continue to apply our time-tested investment process and utilize any volatility as an opportunity to reposition portfolios.
Thank you for watching. Please visit our website at winthropwealth.com to view the full written version and to read our latest commentaries.